All right, everyone, I hope you enjoyed the lunch, but that you saved room for the whole hog barbecue later this evening. This morning we covered a lot of the basics, a lot of the whys behind Bitcoin, how it works. Towards the end of this morning, we started to talk about the real world practical applications. We're gonna continue to go down that rabbit hole this afternoon. And to kick that off, we have Ilya Rekhter of Megawatt, Andrew Hohns of Battery Finance, a division of New Market Capital, and Marty Bent of TFTC, Rabbit Hole Recap, and a partner at 1031. Coming up, guys.
Is everybody a little sluggish after lunch? How are we feeling? I think this is actually a great panel to follow up on Glenn's presentation before lunch, especially having Ilya and Andrew here. Before we jump into the meat of the conversation, why don't we just introduce yourselves, what you guys are working on, and
Sure.
Yeah.
Sure. Well, first of all, thanks for organizing this to build, and Matt Dines, who helped schedule everything for us. So my name is Ilya Rekhter. I'm the CEO of Megawatt. Background, before Megawatt, I ran a software company called Double Map for about 10 years, having nothing to do with Bitcoin. We actually did software for public transit, and Jefferson City was one of our clients. So been here a lot of times. Since then, we actually sold the company, got acquired by Ford, and it motivated me to go further into Bitcoin and build Megawatt, which is Bitcoin mining in Indiana. So I'll get into it later, but it's a way to basically stay in Indiana and invest in Midwest infrastructure.
My name is Andrew Hohns. I'm the Chief Executive Officer of New Market Capital and also our Battery Finance subsidiary. New Market is an institutional asset manager focused on structured credit solutions, and Battery is a subsidiary that we've established to develop institutionally oriented approaches to Bitcoin and credit.
Yeah. So I think between the two of you, we have really interesting ways of leveraging Bitcoin to solve some of the systemic problems that exist in this economy. I think, Ilya, starting with you, like, what about Bitcoin and Bitcoin mining particularly allowed you to stay and reinvest in your community in Indiana?
So it's funny, I'm a Bitcoiner and I'm a Bitcoin miner that I'm very, very passionate about. But beyond that, especially once we sold the last business, Indiana, in a similar way, I think, to Missouri and how Matt and Natalie, I think we're talking about it, has a brain drain where most people who sell a business in Indiana, they go to Miami, they go to Austin, they go to San Francisco. I wanted to stay in Indiana, reinvest in my community, and raise my family there for quality of life and a lot of other reasons. So I spent about a year thinking of what business can I start in Indiana where we could have a competitive advantage. So like AI and large language models is all the rage right now. But there's nothing specific about Indiana, in my opinion, that means that Indiana is going to be the place where that wins. You can try, and some people might be successful, but there's not some inherent competitive advantage. But when I started looking at Bitcoin and Bitcoin mining, I started working with the local Economic Development Corporation and all the people that I knew in the state, and realized that there's a town 45 minutes north of where I live in Indianapolis that I had never heard of, even though it's a short drive away. There was this warehouse that burned down. It was a 900,000 square foot warehouse that burned down in 1994, so almost 30 years ago from now, and it's been sitting vacant for that entire time. So if you visualize this, it looks like a bomb went off where the concrete is left, there's a couple like stray columns, but everything else is either charred or just completely gone. But there's electrical capacity as a result left over in the substation that's not being used. Beyond that, we have that concrete there to where we need a stable floor essentially for Bitcoin mining. So that was a perfect place to go in and put in, we use a containerized solution, put in Bitcoin mining and reuse that electrical infrastructure that is left over. And then to put it in more perspective, that town, the majority of the people who live there or used to live there worked at a GM plant in a nearby city that closed around that same time. So since we've been in that community, on Main Street, there's a building that's just collapsed from neglect, so it's looking bleak for this rural community. So if the state of Indiana has a brain drain, these small towns definitely have already experienced it, and it's not only going to get worse, but there's no reason that it would get better. Enter Bitcoin mining, And we're not unique. There's a lot of these industrial buildings that have either been neglected or completely abandoned, leaving that electrical capacity left over from Rust Belt days and automotive days. Bitcoin mining is this unique tool that can come in, rebuild that community, reinvest in it. And what I told the mayor and the city council is they can have whatever opinion they want on Bitcoin. I can try to orange pill them, but even if they don't see eye to eye with me on that, we get taxed and they can go build some roads, hospitals, and schools and improve that community. And that's something I've become really passionate about.
And when it comes to acquiring the power too, you have the substation with a lot of capacity, it's not being utilized. What does a miner coming in, going to utility say, hey, I'll buy the rest of the power that you have capacity for, you can get it delivered. What does that do for pricing for you and then the residents in that town?
Yeah, so in a pretty direct way, I'll speak for myself, but probably Bitcoin miners as a whole, we're cheap. We don't want to pay a lot for power. And if you think about just really basic economics, there's a reason that people aren't mining Bitcoin in San Francisco, because people will pay more for that power than my company and my miners. So Bitcoin miners nationwide, worldwide, are incentivized to find the lowest cost of power. And typically, that is available in places where there is electrical capacity for X, Y, and Z reason. In our case, automotive days that have since gone the way of the dinosaur in Indiana, but the energy infrastructure is left over. And it's cost effective because it's unused, but they need to keep it at a stable base load. So we can take it, they're happy to give it to us so that we can help balance the grid for them. And it's a win-win for both. And if ever, I think we've heard Warren talk about it as well, if ever there's a demand by neighboring communities, or we're part of the PJM grid, so stretching all the way out to New Jersey from us and all the way up to Chicago, we're happy to shut down and curtail since we're part of the grid and turn off at a moment's notice and release all that energy back to people's homes, specifically so they don't experience those price spikes.
So this is a very physical implementation of Bitcoin into a small rural community. Andrew, I think what you and the team at Battery are working on is extremely fascinating because you're really approaching this from a credit perspective. How do you finance and empower small business owners using Bitcoin and infusing it in credit? So how do you view Bitcoin as part of credit product enabling smaller businesses to grow their business?
Well, Bitcoin is a great tool for savings. We've heard that on a variety of panels this morning. It's fungible, it's finite, the new supply is scarce, it's weightless, it is protected by the largest computer system in the world, it's ubiquitous, it's accepted in so many different countries, it has a lot of liquidity support, trades 24 hours a day, 7 days a week. So it's excellent from a collateral point of view. It's excellent as an instrument of savings. What we've been thinking about, our orientation over the years has been credit solutions. And that's worked really well for 40 years because rates have been coming down year after year. And so people have been able to make an investment, generate some income, and actually at the end of it, usually, it's somewhere along the way anyway, sell the investment at a premium because the rates have gone down and the value of that initial credit investment has increased. Those dynamics have shifted significantly with inflation and with rates where they are. And so now if you're a credit investor, if you make income and you just get back par in 4 years or 6 years or 8 years, potentially it's very destructive to the real purchasing power of the investment, even net of the income that you make. And a lot of credit investors, they need to generate income for very specific reasons, right? If it's a pension, maybe it has beneficiaries. If it's an endowment and a foundation, maybe it has scholarships and research that it has to fund or some other charitable purpose. And so you have investors that continue to have a need for income. They have to be sensitive to this inflation environment in the sense that the real value of their investment could significantly decrease over the course of 4 years, 6 years, 8 years. And they also want to figure out a way to defend against that and participate in some of the opportunity associated with Bitcoin. That's on the one side. On the other side, from a borrower point of view, there's a really strong incentive to hold Bitcoin as savings, as a tool for savings, as a small business. So we've been thinking, gosh, what could we do if we try to unify these two communities around financial product? And I'll give you just, a simple example. Let's say that you're a pizzeria, and you have your pizzeria, and you want to buy another pizza oven in order to expand your pizzeria. And this is very good for you because you make very good pizza, it's your dream, and you're mixing your own labor with capital, right? And so by adding your own dream, your passion to make pizza, your labor with capital, i.e. a pizza oven, you have a chance of adding value that would enable you potentially to make a lot of pizza, or even to open up a second pizzeria, or if you really stick with it for 5 or 10 years, maybe to open up a chain of pizzerias in your region or even nationally. Who knows how far it will go. And so it's very good for you to invest in your pizzeria. But if you could also invest in Bitcoin, it's hard to beat the growth of Bitcoin, right? We've seen how powerfully this asset is appreciating over time if you have a limited amount of money. Let's say that you have $40,000 worth of Bitcoin and you want to buy a $20,000 pizza oven. Very difficult decision to sell the Bitcoin, pay the capital gains tax on it, and buy the pizza oven. But if instead you could come to a solution like Battery and what we're building and say, okay, we'll make a loan for $20,000 to buy the pizza oven. And that loan is collateralized by the combination of the pizza oven and the Bitcoin, the $40,000 worth of Bitcoin. And we'll share in the long-term appreciation of the Bitcoin. And in exchange for that, provide an interest rate that is actually considerably lower than what the business owner would pay for a loan that was supported by the pizza oven only. Then this is a way for a business that puts Bitcoin on its balance sheet to obtain access to superior forms of long-term financing without the mark-to-market risk associated with short-term financing and Bitcoin. And if you can then kind of project that to all kinds of different possible businesses, whether it's not just pizza, but dry cleaners that need new machinery, or people that want to open up a restaurant, or somebody that wants to redevelop a building like this and turn it into an event space, or beyond small businesses, commercial real estate owners that might have a multifamily project, or project finance assets like even a power, solar, or wind with a long-term power purchase agreement. This becomes a very fascinating kind of combination of a little bit of Bitcoin and a large amount of traditional assets, long-term financing, really potentially highly value-added financing solutions.
I mean, people often talk about Bitcoin as a lifeboat, and Bitcoiners have this discussion, like how do we get as many people on as possible? And I think, Andrew, your solution of Battery is very interesting because you hear the Federal Reserve and Janet Yellen talk about the concept of a soft landing, but if we're really trying to approach the structural problems that exist throughout our economy wisely, I think something like these types of products are actually the vehicles to manufacture a soft landing at the end of the day. Is that a bit presumptive on my part? Or?
I mean, I'm 45 years old. And I was looking back, 1981, the funded federal debt was $1 trillion. Now it's 42 years later, it's 33.6 or maybe 7, I haven't checked it today, $trillion. So in 42 years, that's 33x. That's big. When Obama took office, January 2009, it was 7.6 trillion. Now it's grown, 26 trillion, right, in the 15 years since then. And when you look at the percentage of the federal debt that's dedicated to interest, you look at the non-discretionary spending that's not going to be cut. Entitlements, you look at Social Security that's literally projected to have a zero balance in 2035. In 2035, Gen X, which is my generation, will be 7 years into retirement. 40% of Gen X, according to a recent study that I read, has $0 in retirement savings, and the mean retirement savings is $40,000. And And so you have the oldest members of Gen X born in 1963, 7 years into retirement, Social Security is a zero, very little retirement savings to count on. I don't think it's going to be actually a complete dissolution. I think that what's much more likely to happen is a very significant depreciation of the currency. And if somebody is expecting $2,000 in Social Security payment today, could be by then they're receiving $4,500, but $4,500 in 2035 might be like a lot closer to $400 today, even though the number is bigger, right, in units of dollars. And so it will allow political folks to say, oh, we've solved this, we've actually delivering greater and greater amounts of Social Security. And so to me, the base case for where we're headed is significant asset level inflation over the course of the coming years. We talk about the liquidity supernova of COVID. These things typically take 7 to 10 years to reach really significant inflation levels. We're at the early stages of that. And so, but still, you know, you have to have a sensible approach, and you might still need income. You still have to invest in things today. And so this idea, you say a soft landing, it's kind of like alloying together a little bit of Bitcoin with a lot of traditionally financeable credit approaches, somewhat dampens the volatility of the Bitcoin only, and at the same time enables both sides to really benefit. So yeah, I mean, I think it is a good approach to, I think it's a really excellent approach.
And Ilya, back to you. I mean, particularly around Bitcoin mining in rural areas, this panel's titled The American Industrial Renewal. I think it's very funny. It's a bit paradoxical because Bitcoin miners get picked on a lot for using a lot of energy. Sometimes when we come into rural areas, people will try to kick us out because we make a lot of noise, and they view us as soaking up electricity that could be used otherwise. But as we've discussed throughout the day, Bitcoin miners are basically playing an arbitrage game. They're going to find the cheap energy where nobody's using it so that they can mine cheaply. And it's really paradoxical because people pick on Bitcoin miners, and when you really think about it, Matt, in the opening keynote today, really discussed the problem of globalization and Triffin's dilemma, where we essentially forced the dollar reserve system on the world, and by doing that, we flooded other countries with dollars, and to do that, we needed them to manufacture our goods. So we hauled out this industrial base here in the United States, and when you really think about it, Bitcoin miners are fixing the problem that Triffin's dilemma created in the first place. And so speaking to that and what you guys are doing at Megawatt, that really highlights this intuitively.
So there's a direct economic incentive for Bitcoin miners to locate in industrial rural communities. Virtually no other business has that incentive, which is why we've seen what we've seen in states like Missouri and states like Indiana. We can talk about when it happened or why it happened, but I'm a realist. We are here today, so my question is, how do we improve rural communities in Missouri? How do we improve them in Indiana and other states, right, that are considered flyover states by a lot of the other people in America? And it's almost crazy to me that because it's obvious that Bitcoin mining is a vehicle to do that. Now, we're an industrial player, so we use many megawatts of electricity, but there's 16 publicly traded companies today that are just Bitcoin miners, to where the majority of them right now are in Texas. If I was Missouri, I would be fighting tooth and nail to bring them here. If I was Indiana, I'd be upset about that, and I'd be fighting to bring them to Indiana. Like, here's an industry that's high tech, that can keep this talent that we have in these states that graduates from WashU or graduates from Mizzou here, because it is a hot industry. Keep that talent here, use infrastructure that we already have. In some cases, you can build new stuff if you're trying to build a 200 megawatt project, but you can build dozens, if not hundreds, of 5 megawatt projects that are still very large as far as, you know, revenue in terms of taxes, jobs that they create, supporting the Bitcoin network. All of those things are net good, and that energy exists today. We don't have to create new energy because of the flexible load that Bitcoin mining creates, meaning that if we ever reach that peak that Warren was talking about, Bitcoin miners are happy to turn off. So it's not something where we want to turn on and stay on at any cost. The analogy I use is, you need to turn somebody off if you reach that peak. You probably don't want to turn a hospital off. People will die. You can turn off a Bitcoin miner. We can turn off a heck of a lot faster. Nobody dies. There's revenue loss in terms of Bitcoin opportunity cost, but the Bitcoin network still works. A new block will continue to be found every 10 minutes, so everything will continue to work smoothly. So as long as there's economic incentives there, which are already there in place today with curtailment opportunities, it's a very natural tool that we can use in states like Missouri to rebuild this industrial infrastructure.
Yeah. And this opportunity exists off-grid too. I mean, we see it in Tennessee. I think there's a massive opportunity. We have a massive stranded well problem here in the U.S., particularly in Appalachia and other parts of the country, where you have these shallow oil basins where they really cared about the oil and not the gas. They got all the oil out, and then they're just leaving these gas wells behind that aren't being maintained. And as a Bitcoin miner, that is an energy arbitrage play where you can actually use Bitcoin mining as a mechanism to solve this massive stranded gas problem. It's much smaller scale, it's much more of a logistics problem. But if the economics of Bitcoin mining get to such a place, like, people are gonna figure out how to get the cheapest energy, and that's just one other opportunity.
Can I actually unpack that a little bit? So you frankly know more about this than I do, so I'll speak as almost a novice because this is different than what Megawatt does, but I think arguably it's cooler and more interesting than what Megawatt does. So yes, we are rebuilding rural infrastructure, and that is awesome. That should continue to happen. But this stranded gas problem, if you've seen a movie like There Will Be Blood or something like that, where you can see this flare of gas going into the sky, that's releasing pressure from gas that needs to go through a pipeline to civilization, essentially. No, you can capture that and you can do something with that energy, but again, if you think about what other industry would be okay operating in the middle of nowhere, oftentimes there's no roads, there's no plumbing, there's no bathrooms, there's no heating or cooling. These pipelines are very expensive to build from those locations, and there's very few utilities. So you put Bitcoin miners there, you capture that flare of gas, you turn it into electricity that powers 100, 200, 300, however many Bitcoin miners, and those miners work off of a cell phone connection in those rural areas. And it's not perfect, but again, it's good enough for Bitcoin mining to where all of a sudden you have a flare of gas that otherwise is going into the atmosphere and a net negative. All of a sudden it's being captured, which is good for the environment, turned into Bitcoin, so there's an economic incentive to do that, and it all works wirelessly. It's just fascinating technology that didn't exist before Bitcoin.
Yeah, it's one misconception with Bitcoin mining. It is very energy intensive, and people take that to mean that it's bandwidth expensive too, but miners, when they're sending hashes to a mining pool, it's kilobytes of data, so you can use the cellular signal to send that to a mining pool. And flaring is just one aspect. The stranded well problem, where you have these unmaintained wells, the miners that show up and use the gas at those wells are incentivized to maintain it, so you don't have as much methane leak. There's a lot of opportunity there, but we don't have to fall too deep down the stranded well rabbit hole. One thing I do want to really touch on, again, thinking of the name of this panel, the American Industrial Renewal. I mean, I think, Andrew, throwing this to you as a fellow Philadelphian, both from the city where the Declaration of Independence was signed and the Founding Fathers fought for the ideals that we really grew up imbuing, how does Bitcoin align with the American ideals that we think we should be striving for, maybe getting away from today's day and age?
Well, it rewards hard work, it rewards diligence, it rewards savings, it rewards long-term planning, it lowers your time preference, and I think it was someone on another panel or maybe a podcast I was listening to recently who said, when you get involved in Bitcoin, a lot of people, it really even changes your perspective on life, right? I mean, a lot of people start to eat differently. A lot of people start to think about how they're spending their time differently or exercise more or what have you. And when you're in a fiat mindset where, as quickly as you receive the dollar, you have to do something with it or else it's just disintegrating, or melting ice cube, as Michael Saylor put it. That's a totally different mindset than where if you have Bitcoin, and the longer that you can keep it and protect it and maintain it, the more energy it's radiating. It's a very powerful setup. And so when I drive through Philadelphia, it's funny to be here, here in Missouri. I have the good fortune of being able to travel through a lot of the United States. And I think that what our country has in common is a lot more significant than the things that divide our country, just in my own personal perspective, visiting with people all over the country. And many of the challenges that people are discussing here on the stage today and your hopes for this region are similar to what you might hear if you go to an economic development conference in southeastern Pennsylvania. And if you drive through some of the neighborhoods in Philadelphia and you see these older homes, the average age of housing stock in Philadelphia is about 90 years. And a 90-year-old home is an expensive home to maintain. It's expensive to heat and to cool. It needs more regular investments for a roof, or has to be more frequently repainted, or HVAC has to be replaced. And plus it's surrounded by other 90-year-old homes that also are needing that kind of regular reinvestment. So I'll give you a thought experiment that we did up in the last few months. Because I also noticed, I was reading the Wall Street Journal yesterday, and I also noticed that there have been some major changes to the Community Reinvestment Act that are just now coming through, encouraging more lending for affordable housing in the United States. And of course, everywhere in the United States, affordable housing is a tremendous issue. There's roughly 7 to 10 million too few units of affordable housing in the United States. So how's it work right now? Well, right now, you get like a 30-year mortgage, right? Let's say that you're buying a $300,000 house, which is the median home in the city of Philadelphia, a little bit lower than the national median, roughly $430,000. Let's say you buy a $300,000 house, city of Philadelphia, 30-year fixed rate mortgage, 8.09% interest rate is current national average. You put 20% down, that's a $60,000 down payment, $240,000 loan. The monthly payment on that financial arrangement is about $1,800. I actually put it in the mortgage calculator. It turns out it came out $1,776. So, but in any event, it's about, let's say, $1,800. Now, if you do your part, okay, your part in this case being defined as you pay your monthly payment every year for 30 years, what do you have? Well, at the end of that whole sort of time frame, you have 100% equity in a very specific illiquid asset, your home, which in addition to the in addition to property taxes and insurance, which is on top of that $1,800 a month, and can go up, right, by the way, you also have planned and unplanned maintenance expenses and repairs, and your ability to capture some of that equity. You really have two routes. Either you can sell the house or you can borrow against it, neither one of which is necessarily ideal. And the performance of that asset as well is heavily dependent on how your neighbors have managed this exact same scenario, how your neighborhood as a whole has evolved over that period of time. Is it a neighborhood that happens to be gentrifying or getting interesting restaurants, or is it located near a local employer or on a park or not? And also, it depends a lot on how your city has performed overall. And if you have the good fortune of buying a median home in Nashville, Tennessee 30 years ago, when it would actually have been hard to foresee how well Nashville has done, you would have done a lot better than if you bought a median home in Worcester, Massachusetts, when it would have also been hard to foresee how poorly Worcester, Massachusetts has done over that period of time. And so you're dependent upon all of these idiosyncratic factors. That's the current setup. And all of that, by the way, is made possible by a government system, Fannie Mae, Freddie Mac, and other large taxpayer-backed financing pools that add additional indebtedness to the public finance structure. That's the current system. So here's the thought experiment. What if we blend that same house with one Bitcoin, and we alloy it together, and we create kind of like a financial steel? So now let's say Bitcoin 30,000. It's a little bit higher, but let's just say 30,000. So now you have the same $300,000 house and $30,000 of Bitcoin, and you alloy them together. You think of them as a combined thing. You lend 80% loan to value $264,000. The borrower has to put up $66,000. So the borrower has a slightly higher down payment, the loan is slightly larger. But since, as we'll see, the lender is not dependent exclusively on the interest and the principal for their amortization, they're going to share in some of the upside of the Bitcoin over the long run, you can offer, for example, an interest rate, let's say 5.5% instead of 8.09. You can offer an amortization, let's say 25 years instead of 30. And as it would turn out, the monthly principal and interest payment on a $264,000 loan with a 25-year amortization and a 5.5% interest rate is slightly lower than the monthly payment on a $240,000 loan with an 8.09% interest rate and a 30-year amortization. And so if Bitcoin goes to zero, which I personally don't believe is at all likely, but in any event, if Bitcoin goes to zero, then the borrower is going to own their home 5 years earlier for about a little bit less per month, like 50 or whatever dollars fewer per month. They'll own their house 5 years earlier. That's the downside. Upside, let's say that you offer every year that the borrower is in the house, they vest into 2% of the appreciation of the Bitcoin. So if they pay off the loan in 25 years, they end up owning 50% of the appreciation of the Bitcoin, and the lender gets 50%. If they pay off the loan in 10 years, they own 20% of the appreciation, the lender gets 80%. Now, you've put into the hands of this family an incredibly cost-effective, long-term savings plan associated not with a specific illiquid asset that has property taxes and a leaky roof from time to time, but instead a highly liquid fungible asset that is growing at the adoption rate around the world and has all of these properties that everyone in this room is excited about, me too. And that's a tool for savings and a tool for reinvestment, not just in that person's house, right? They could draw against that equity to make important repairs or renovations, or they could also finance payment for their children's tuition, or an important medical expense, or a small business. It's essentially a store of capital value for that whole neighborhood. And now if you imagine a neighborhood near to here, and I don't know specifically the names of any neighborhoods here in Jefferson City, but I'll just choose one in Philadelphia. You take Germantown, Pennsylvania, Germantown, Philadelphia, founded 1 year after Philadelphia. Philadelphia 1682, Germantown 1683. Incredible old houses, amazing history, somewhat down on its heels. If you put 40 Bitcoin into Germantown and you do 40 of these loans today, that would be what, 40 times 330,000? You could do that for, $15 million. You put 40 Bitcoin for the next 25 years. That completely changes and plus, the people who are in those homes have a strong incentive to stay in that house because every year that they stay in it, they're unlocking more and more appreciation into this Bitcoin that they put on in 2023. And so now you have neighborhoods full of strong capital, and that allows people to reinvest in their dreams. And for some people, that's going to be, a commercial real estate redevelopment. For some people, it's going to be a pizzeria. For some people, it's going to be a service business. Or, it could be any number of things. An education, a master's degree. It could be any number of things. And that, to me, is like a path, right? An actual path and a plan to renewing American industry, and doing so with an asset that drives towards so much efficiency and so much positive decision making, because it's relentless in punishing poor decisions and dependable in rewarding patience. And that's like a really nice setup for long-term thinking. So, it's just a little thought experiment about how you could blend Bitcoin with, a tangible asset and really produce some meaningful changes in the life chances of everyday individuals.
And I think it's really indicative of the opportunity that lies in front of us, which is that we can fix this ourselves. We don't have to depend on the government, whether it's creating these types of credit products or just going out there as a pure capitalist looking for cheap power. We are solving problems that the government for being frank, like cannot solve at scale. Like individuals like Ilya and Andrew getting creative and leveraging Bitcoin, whether it be via the mining industry or using the asset as super collateral and credit products. Like we have the facilities in front of us to start this industrial renewal in the United States, which is desperately needed right now. Because harkening back to panels from this morning, like it's very obvious that something's systemically broken in the financial system, and that is leading to incredible amounts of strife and stress for American citizens. And for some reason or another, everybody keeps going to the government and say, fix this for us, fix this for us. I think Bitcoin is a perfect vehicle where you don't have to go and ask permission to do that. You can just use what's at your fingertips to go fix it yourself.
Yeah.
And I know I got the 5-minute mark. Do we want to open up the Q&A for a few minutes? Yeah. Any questions? Comments?
Anyone?
Yeah.
Hello. Yep. Thanks, guys. Andrew, this is for the Bitcoin loan scenario. How much Bitcoin do you need by like ratio to the loan, or is the typical requirement for a commercial or residential property?
Well, we've looked at a variety of asset classes and a number of different, variety of asset types, let's say, and a number of different time scenarios. But in general, small amounts of Bitcoin have a very powerful effect if you give them the time to grow in terms of improving the credit risk by increasing the collateral value that's supporting the credit facility, but also at the same time improving the overall economics by sharing in the appreciation. So, generally speaking, I think that Bitcoin amounts of 25% or less of the total amount of collateral package are very effective when viewed over time periods of 5 years or more. And for our 2 cents, or I guess 2 cents would be like, what would that be? That would be like 7 sats or something? 8 sats?
Something like that.
Okay, so is that right? No, there's 3,600.
3,000 sats a dollar.
3,000 sats to $1, so that'd be
I just say my 2 sats.
my 2 sats, but that's not enough. So a dime would be like 360, so it'd be 30, so it'd be like 72. So for my 72 sats, for my 72 sats, I would say that it's not time in the market, it's time in the market that counts with Bitcoin. And if you look at that spiral chart that Rational Root has published, time and time again, and others have published it too, right? But Rational Root has a really nice version of it. You can see that every epoch that goes by, that line is almost a full order of magnitude wider than the line before. And yeah, of course, there have been periods where if you are just becoming familiar with the Bitcoin protocol in September of 2021 and you buy Bitcoin at 50,000, it's going to be a rough ride. And your patience will be rewarded if you put in the time to learn about the fact that this has happened before, right? There's a symmetry. This has happened in a similar way in 2017, 2013. Will probably happen in a similar way in 2025. History doesn't repeat, but it rhymes for sure. So if you bought it at the top because you're just first hearing about it and the media fever pitch is rolling and it goes down and you don't have the patience to hold on to it, it could be a bad experience. But if you have the patience to hold on, there's literally no day so far in the history of Bitcoin since November of 2012, which is the first halving. There's no 4-year holding period that has had a negative return, not a single one. And it's like sometimes I think almost like wine. Like I struggle with different analogies for Bitcoin. because Bitcoin's really special, it's unique. But there's some different analogies, like financial steel was one that I tried out. Also wine. So like wine, like if you have cheap wine, you know, you drink it right away. And there's no point in letting that age. Like it doesn't get any better. In fact, it gets worse. It spoils, it turns to vinegar quickly. If you have a really nice wine, really expensive wine, you don't want to drink it right away, right? You want to let it age 3 years, 5 years, in some instances even longer. And if you could start to think about savings in vintages, and you say, okay, this year I'm going to save $100 a month. I'm going to buy Bitcoin. And that's a level that I'm comfortable, barring some extremely remote scenario in my life, I'm going to be able to set aside $100 a month and not have to access it. And I can buy $1,200 of Bitcoin, or whatever the number is, $50 a month, $10 a month, whatever it is. You say, what's that number? I can set that aside. I can set it aside for 4 years. And the earliest that I'm going to open up this vintage of savings, earliest I'm going to uncork this wine is 4 years from now. And then you say, okay, and you keep track of it in a little book. And you know, people have 5-year certificates of deposit, and they're making 5-year. Well, what if you had a time sort of oriented savings plan? You say, well, my 2017 savings vintage, I put in $1,200, and if you put in $1,200, even at the top of the market, if you did it all in December of 2017, you know, when Bitcoin was 20,000, and if you did it along the way, it wouldn't have all been at 20,000, but if you did it all at 20,000, your 2017, and that was at the height of the market, your 2017 vintage would now be worth, you know, if you put in 1,000, it would now be worth, right, like $1,800 or something like that. And if you can hold out even longer, your 2017 vintage is going to get even better, your 2018 vintage. And, you know, so I don't know if that's helpful, but it's just one way that I think about it is that you have to have a long-term mindset, not because you're like hoping, you know, and you're unwilling to face the reality, but because it's a volatile process for an asset to go from absolute zero, which is where Bitcoin started, right? Absolute zero, January 3rd, 2009, to the point where now 34,000 or whatever it is right now, dollars per Bitcoin used by 220 million people around the world. And what's that going to look like in 20 years or 30 years? You know, is it going to be used by 1 billion people? How many companies? You know, MicroStrategy bought 158,000 Bitcoin. How many more companies can buy 158,000 Bitcoin before there's not that much Bitcoin left to go around? Because there's only 2.2 million Bitcoin on exchanges right now anyway. So, like, what if Procter & Gamble and Coca-Cola and Exxon, is there room for all three? It's not clear. And the ETFs, there was somebody who said earlier today, I heard the number. What did someone say? ETFs were expecting over the course of the first few years, what was the number? It was like
250.
What was it? Okay, 200 billion. That's crazy. Like, you know, just stop and think about that for a second. MicroStrategy has spent $5 billion, a little bit less. They own 158,000 Bitcoin at a blended price of 29,000 some odd. So they've spent like 4.6 or $8 billion so far, and 200 billion is, you know, 80 times MicroStrategy. Where is that Bitcoin coming from, right? And if you're in an ETF and you buy an ETF unit, it's not like the ETF manager has any discretion where they can say, oh, Bitcoin price too high, I'm going to wait for it to dip. No, they have a mechanistic requirement to buy the Bitcoin at that time. And, you know, when you have a stock that's valuable, what happens, right? The board of directors gets together and they issue more stock because they feel that they're uniquely situated based on their prior success to do something else. But Bitcoin is not dilutable. And so it's a different kind of financial asset than one to which we have any familiarity. I'm going on, I'll stop. But
It's going up forever, Laura.
When you get to know Andrew, you'll know that he can talk about this stuff forever. So
yeah.
let's give it up for Ilya and Andrew.
Thanks, guys.
You guys are... A lot of passion.
Big round of applause for Andrew, Ilya, and Marty. Thank you
very
guys.
much.